Thanks, Karishma, so much for that. Let's go across to Sanjay Aggarwal now. He's joining us, PhD, Chambers of Commerce and Industry. Mr. Aggarwal, thank you so much for taking out time for us. Can you just talk to us about the guidelines that have been issued by changes in the PLI scheme for API? What are these changes, and what does this essentially mean?
PLI scheme for the APIs I think I am not fully aware of the details. In fact, what I do understand, of course, is that the PLI scheme is designed to very substantially encourage the production of APIs in the country. And one hopes that the dependency on one country, China, that we had suffered for so long will now be sorted out. I think this is what limited knowledge I have on the subject, because I'm not aware of any immediate or recent changes in the PLI scheme for API.
Right. Can you just tell us about the recent changes that have happened? What could that essentially mean for the overall export? And I'm not only talking about the PLI scheme, even other schemes. What is the sense that you get?
You see, I think overall in general, PLI scheme is something which is WTO compliant, and it is it's expected to boost our domestic production in line with our Atmanirbhar Bharat targets. I think that's a good plus, and overall it's very encouraging that our exports in the month of September have actually gone beyond the year-on-year figure that we had last year. So I think on export front, we already are on the right track, and if we keep stressing on the right measures to ensure that the domestic production does remain competitive internationally, I think it's very good. But I think overall, when we talk of the economy today, I think in general, from the PhD Chamber of Commerce, we have recently released an index of 25 fast-moving indicators of the economy. We call it the EBM index, Economic and Business Momentum Index. So out of these 25 high-frequency indicators, we have seen that 20 indicators are in the positive territory. And we are on the strength of these now, we are now looking at a deceleration of the GDP for the current financial year at minus 7.9% compared to the usual predictions of 9, 9.5 or 10 that one is usually hearing. In fact, even RBI has indicated minus 9.5%, but we are ready to stick our necks out and say that on the basis of our data, we are looking at a minus 7.9% deceleration for the current financial year. And we are hoping for a 7.7% financial plus on the GDP side in the next financial year. I think what we are looking at now is the need for a demand creation in the economy. That is, the crux of the issue. I think supply side has been taken care of to some extent by both the fiscal and non-fiscal measures, by the support provided to a lot of borrowers in terms of moratoriums and in terms of interest waivers also in many cases, especially for MSMEs. But the issue is that to generate the demand in the economy today, we need investment. We need a lot of demand to happen, and that is not going to come at this stage from the private investors who are diffident, even from the private consumers whom the government is very rightly trying to encourage to come up with more expenditure, but in various ways of incentivizing expenditure, including the LTC encashment policies on purchases and all. But end of the day, what we need is really a genuine demand creation, which will happen when there is a major investment into the economy coming from the government. So the 2% odd that fiscal stimulus that has been actually there till now has helped in the supply side maybe, but for the demand, I think we need from the PhD side, our request to the government would be to consider at least 8 to 10% monetary stimulus to the economy. And this should come as soon as possible to ensure that the government sector invests and that spending goes into either into DBT, which has been happening to quite an extent, but then thereafter into infrastructure, into building the infrastructure, into looking at the 111 lakh crore national investment plan, the infrastructure investment plan that has been announced by the government, but has not really taken off because of the shortage of funds. So I think these are the things that one needs to address at this stage.
Right. When you say about the demand, what do you essentially mean? That is the problem for capacity utilization. So essentially it's all a circle which just comes out to why CapEx should happen.
Absolutely. You see, the industry, the private business, the private trade is diffident right now on the prospects of the economy, and rightly so, because we have had a pretty bad last 6 months. The economic indicators are very positive. They are showing a lot of uptick, and we are, as I said, hoping for a 2% or a 2.5% difference between the usual predictions and our PSD numbers for demand for the GDP deceleration. But having said that, I think the confidence among the consumers or the private businesses is not there to be able to invest. And unless we invest in big numbers in the economy today, we are at the risk of going into a negative cycle, which can be very dangerous. I think we are in a war-like situation. This pandemic is a war, and this calls for extraordinary measures. We should not overly be concerned about figures like deficit numbers. I think what we have to look at is the capacity to borrow. Our country, India, that way is very, fortunately positioned. I think our external debt to GDP ratio is in the region of 20%, compared to numbers like 90% or 100% for large economies like USA, 80-90%. Or Japan, I think it's 83%, and it's 300% for UK. So why should we be too afraid? I think if we can create some development financial institutions, which the country is totally lacking today, after the demise of the earlier DFIs or their conversion into banks. I think today what we need is long-term funds, which can be provided by mega DFIs, which get funding on government guarantee, and which then on lend to mega projects or all projects initially belonging to the government, but later on, as the confidence develops, also to the private sector. If this sort of an investment goes into the infrastructure of the economy, we'll be doing a double service, service in terms of actually addressing today's woes, but also service to the nation in terms of building up the future. It's going to be something like what the USA did in the New Deal after the Great Depression of the 30s. I think that was sorted out only because of the huge investment that went into their infrastructure. So we being so strong, well-positioned on the external debt ratio fund, I think as a nation, we need to take some hard decisions and not be afraid of some temporary downticks by some rating agencies, which in any case don't inspire much confidence nowadays. In any case, what we have to do is to look at our long-term interests.
Right, sir. Thank you so much, sir, for taking out time for us. Always good to get perspective. Let's go back to Karishma. We have another update coming in from the ethanol hike. Karishma, take it away. What are you picking up?